Hi guys. Just as we all thought we could kick back and relax for Christmas, just as Joe Crew's getting a little bit too comfortable in his Christmas jumper, Bank of Japan going surprise markets with a hawkish shift to policy by tweaking the yield curve control target from the previous 25 basis points to now 50 basis points. Knee-jerk reaction to markets was initially global equities sold off, bond markets sold off in sympathy, US Treasury yields went higher. Reason for that is because Japan is one of the largest capital exporters to the world. So when Japan adjusts policy back home, there's a potential for a change in portfolio allocation, and particularly with high yields back home to move some of those assets, sell foreign assets and move that back home. Initial thoughts, the Treasury move, I'm inclined to fade here. I know I've held a bullish bias on Treasuries for the last few weeks, but I don't think this changes that too much. A couple of reasons being, number one, for Japanese investors to hold hedged Treasuries, hedged back to Japanese yen, it was yielding negative in a way. And as a consequence of that, throughout the course of the year, on net, Japanese investors have been net sellers of treasuries. So I don't think that overly changes the portfolio flow from that perspective, and won't lead to sort of aggressive selling of treasuries. In terms of what I think is actually driving sort of treasuries higher is the three things we've spoken about before. I think we're peak CPI, we're peak Fed in terms of we're coming towards the end of the Fed hike cycle, and also now the third thing is obviously we're growing more concerned about a recession in the US. So I think those three factors will keep yields coming lower. Just to quickly look at some charts and some levels to look at 10-year yields. So we kind of faded out above levels around 372, which is a bit of a level, some sort of previous lows, and also some previous highs. 380 is a bigger level to watch. It was the highs at the end of November. So kind of watching those levels, but I'm expecting those to break down. The biggest moves that we're seeing today has been in dollar yen. So dollar yen has fallen around just over 4%. Market's still very short yen. And I think the interesting thing for me is this kind of feeds the narrative post ECB as well, that other central banks are playing catch up with the Fed, which should ultimately lead to a weaker dollar. We've spoken before about the importance of dollar for global liquidity and financial conditions, and that strong dollar was the dollar wrecking ball. Well, that's reversing, and it continues to reverse. We kind of bounce off some levels, and we're now coming back lower, reversing the moves we saw post Fed. So if I look at the world and I think, okay, if I'm right on yields being capped out, and actually reverse lower, US yields coming lower, dollar coming lower, I think generally that's going to be quite good for risk. So equities, I think, remain supported. I think if equities remain supported, crypto remains supported, all things equal. If nothing else, Mrs. Watanabe has got a stronger yen to go aping into some Bitcoin with.